Brian's Investments. Thanks again for joining us. Don't forget to hit that like button and subscribe to my channel. We got a lot of really great things going on. Justin has joined our Discord group for ATMs. He's an expert on ATMs and a processor. So if you want to get into the ATM business, definitely join the Discord and drop some comments in there for him, and he'll walk you through everything and help you get started. Walter has joined us. He is a real estate investor and real estate agent. So he's done real estate in 4 different states, and he's an expert on that. So here and there we're starting to bring in some experts in each of the passive income fields, which is going to really greatly help everybody out. This episode we're going to be talking about stocks and crypto, which I'm really excited about, and it's what everyone's really been waiting on. We're going to talk about price targets, FOMO, diamond hands, stonks, IPOs, things like that, and just terms about the stock market, what I'm actually doing, what I'm investing in, and things like that. So let's go ahead and get started. Okay, so price targets, which is abbreviated PT, is what analysts and experts in the market are pricing a stock at and value it to where it should be. There's something called undervalued stock, overvalued stocks. Of course, you always want to invest in undervalued stocks. That means they are incredibly undervalued and are going to go up in price 200, 300, 500%. Overvalued stocks means you may be paying more than what it's worth. So if a price target is $10 and you're paying $18, you're overpaying. If you're paying $4, then you're underpaying, which is a good thing. So always look out for price targets. You can just Google them or look in stock news and just put in something like Tesla price target. It's not accurate information. Nobody knows exactly what it'll do, but it'll give you kind of a idea of if you want to invest in it or not. Basically, if a price target's $15 and the stock's trading at $16, you may not want to invest in it unless you know a lot about that company and the future of it. The term behind FOMO is exactly what happened with GameStop, AMC, and all those. It is fear of missing out. Meaning when a stock is normally at $10 and all of a sudden it's at $100, everybody starts investing and they're like, wow, this is going to go to $1,000, and then what happens? Pump and dump. Everything drops out and it drops way down and you lose out all your money, and the stock may not ever go back up to the same price that you bought in at. So a lot of people get FOMO, and it's not a good thing when there's a lot of hype and a lot of people talking about stocks and they're saying, oh, get into this, and there's thousands of people saying it. Chances are you don't want to get into it. You really want to find the ones that people aren't talking about yet. So that's kind of what FOMO is all about. Avoid it at all costs. Alright, so the next term is called diamond hands. It looks like this. And what it means is it's a long-term hold for anybody come hell or high water, no matter what the risk is. Often a group gets together and holds forever. Diamond hands means you will not sell no matter what happens. If it dips or goes up, that's what the diamond hands is all about. Another term that we come to is stonks. I'm confused by this one, so I'll just read it to you. It says stonks is an intentional misspelling of the word stocks, which is often associated with a surreal meme featuring the character Meme Man, standing in front of a picture representing the stock market, followed by the caption stonks. It's in relation to jokes about poor financial decisions. And another term for it is a noun, a concentrated artillery bombardment, a mortar stonk, which in my opinion that means it goes down. Just the floor drops out, it blows up, but it could mean it goes up, because every stonks meme I've ever seen is it's showing the arrow going up. So I'm kind of confused on that one. Alright, next on the list is the bull and bear market. On one side you have your bulls, on the other side you have your bears. So what this is a bull market. Its trend goes up. The value of stocks go up. The price goes up. Something in a bull market you don't want to do is buy in when it's high up. And then, of course, in a bear market, it means people are selling. The value of stocks is going down. Right now, as of recording this, the stock market is crashing and going down because it is a bear market. So it's going to be a while before recovery happens. Let me show you a chart exactly what happens in a bear market and how long it takes to recover. Alright, so you can see here, this is S&P 500 bear market in recovery. The dark blue line represents length that the bear market is in months. The orange is the recovery in months, how long it took to recover from that market. And the light blue down below is the percentage that the S&P 500 dropped. And so you can see that, it was a bear market for 14 months. It took 11 months to recover. Bear market for 6 months took 14 to recover. Over here is 21 to 69%, which is huge. But look at the massive drop, 48% on the S&P 500. So it can take a long time to recover from a bear market. So we want to stay out of that. So every time that you buy and hold, you're helping to stay in a bull market. Every time that you sell, you're pushing us further into a bear market. So, but however, in a bear market right now, everything is at a clearance, so you'll definitely want to buy as much as you can. Alright, so basically in a bull and bear market, a bull market is a lot better for investors. Unless you're trying to buy in, then you're going to want a bear market. But just know that since we're in a bear market right now, you should only be buying if you're panic selling and want to get out. You're going to lose a ton of money. If you hold, you won't lose anything unless the company actually goes bankrupt, which is probably not going to happen with 99% of these companies. But just hold it long term and let it go up and don't take a loss. Alright, so for our next one, it's IPO, which is Initial Public Offering. What it is when companies are in business, they're a private company, and basically the company owns all their shares unless they have partners or anything like that. But when they go public, they actually sell shares of their company, so you own a percentage of that company. It allows the company to get a whole lot more money and all that. So with that, like let's say cricket cutters have been around since 2003. They are just now doing an IPO, going public with their company. Some companies have been around, like Electronic Arts was like 1989, so they've been on the stock market forever. So a lot of times you can go to the NASDAQ, New York Stock Exchange, S&P 500, look at their IPOs that are coming up, and you'll be like, wow, this company's been around 20 years. I can't believe they're just now going public. Not all companies go public. When you see it on the IPO list, they don't always get listed. They will back out and try again later, or just decide it's not for them. So once they're actually priced, you can know that they will be listed. It's really hard to find what exact day they're going to IPO for. You're going to have to do some research. Sometimes it's a little easier, but then sometimes you won't know until like the day before at best. There's reasons behind this, but sometimes you can actually invest in an IPO before it goes on the market if you can, buy 500,000 shares. Yeah, once it goes public, that priced at $14 could all of a sudden be $30 when it hits the market, and then all of a sudden it could tank within a couple hours and eventually go back up. So just be careful with brand new IPOs. You can make a ton of money in them, but you can also lose short term in them, so just be careful. But you could also lose long term too, depending on if there's a lot of hype for a company that's just not a good company or doesn't have a good product or service. Alright, so something that people don't really talk a lot about is pink sheet stocks. A pink sheet is something that's traded over the counter, and you will not find it on a major stock exchange like the New York Stock Exchange. So generally it means that they do not meet the requirements or the regulatory requirements to actually be on there. So you have to buy those off the market in a different way. Most of them are penny stocks, so anything under $5 a share. But that's all that means. They're very speculative, so you just have to be really careful with them, because if they don't meet the requirements of the market, then is it a legit company, or is this company going to survive? But so that's what a pink sheet is. So be careful with them, but they could be a good thing. Just think penny stocks. Alright everyone, thanks again for watching this video. We've run out of time. It's already over 10 minutes long on this video, so I'm not going to be able to show you my portfolio or to talk about other things in the stock market, but didn't even get to really touch on crypto, but that's okay. I got a lot more videos to come. Please go ahead and just smash that like button and subscribe to the channel so you don't miss out on any of the videos. Thanks, and see you next time.